Crisaline Vanlet is a director of finance with 23 years of work experience in the industry. A financial manager directs a company or its management in meeting its economic and financial goals. Driven by the love for analysis, problem solving, and having a voice that can be heard, Crisaline loves to bring value to the organization she is working for. Definition of financial manager and the roles that they play. The financial market is any location or system that enables traders of financial instruments, such as derivatives, bonds, shares, and different global currencies to transact. The connection between people with capital to invest and those who need capital is facilitated by financial markets. This is where financial managers come in. Financial management plays a major role in achieving an organization's success. An organization has short-term and long-term goals. To meet those goals, financial management helps through financial planning, financial analysis, and management of resources for leaders to do decision-making. The financial manager's goals are to increase the company's revenues and minimize expenses. This, in effect, will increase the bottom line or technical terms, net profit. Another goal is growth or to increase the company's value. A company needs to use the resources available in an efficient manner to meet this goal. Risk return is a theory of the higher the risk, the higher the return. The lesser the risk, the lesser the return. It depends on someone's appetite as to how much risk they can take, whether one is conservative, aggressive, or somewhere in between. Financial managers need to know investors' appetite to risk, meaning how much risk they are willing to accept. From there, financial managers can create a strategy for investment decision making.
Goals of financial managers. The financial manager's goals are to increase the company's revenues and minimize expenses. This, in effect, will increase the bottom line, or in technical terms, net profit. Another goal is growth, or to increase the company's value. A company needs to use the resources available in an efficient manner to meet this goal. Risk return is a theory principle of the higher the risk, the higher the return. It depends on someone's appetite as to how much risk they can take, whether one is conservative, aggressive, or somewhere in between. Financial managers need to know investors' appetite to risk, meaning how much risk they are willing to accept. From there, financial managers can create a strategy for investment decision making. Trends in the industry. Given a system that constantly changes according to the effects of the government, international transactions, and others, there are bound to be short-term and long-term trends in the financial market. Risk management is one trend. With so much fraud happening daily, the industry continually improves security. Another one is automation. When the pandemic hit, everyone needed to keep their distance, yet we still needed to continue doing business. Companies put more effort into automating processes to accommodate the needs of the industry.
The coronavirus pandemic back in 2020 affected a multitude of industries because of social distancing and lockdowns. Industries such as food and service, airlines, hotels, and others. And one of those others is the financial industry. The pandemic caused a global economic crisis, which we can still feel today. It may take a while before the global economy can go back to what it used to be. The debts of the government have increased. Many small to medium enterprises did not survive the pandemic and had to close their businesses. There were also challenges in supply chains. Manufacturing was disrupted, so there was a huge reduction in supply.